We negotiated out, I think I gave him 10% down, and he just wanted the federal minimum interest rate. So, I mean, I pay nothing in interest on this thing. And It's on a 15-year note. It's fully ammed on 15 years. It's a super cheap payment for 5 properties.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
Hello and welcome to the RPOA Seller Financing Panel. We've got a great group of experts up here today who will help us understand what seller financing is and how it works, different types of seller financing, some of the legalities to be aware of, and how to do it right. I'd like to start by introducing our expert panel. At the very end is David Hill. David is a real estate attorney with Barnes & Thornburg LLP. His specialties are real estate and real estate finance law. And David's here to lend a legal perspective to the panel. David was also a guest on the podcast, episode number 12. Next to David here is Justin Workman. Justin is a residential redevelopment specialist. He's a landlord, investor, and home buyer. His company is called Workin' It Properties, LLC, and Justin has experience with various types of seller financing. Justin's also been a guest on the podcast, episodes 351 and 67. Javier Rodriguez is a real estate broker at Lake Michigan Realty Management, and he has sold over 500 properties in Kent County. He's also a former loan originator with experience providing his clients with seller financing options. Steve Whittaberry, closest to me here, has 10 years experience as a real estate investor in West Michigan. He's done fix and flips, buy, repair, and holds, and he's purchased properties using seller financing, and he's sold 4 properties using seller financing out of his self-directed IRA. Steve has been on the podcast several times, both episodes 19 and 20. So thanks for being here, guys.
Thank you.
Let's get started. I'm going to start with you, Dave. My first question to you is just very basic. Please help us understand what seller financing is.
Sure. At least how I look at it, seller financing comes in really 2 primary buckets. One is the traditional seller financing that you think of, I think probably most of us are thinking about, is a land contract financing. So you hold title to the property, so the seller retains title, but you transfer by land contract, and then you pass the deed later on when the land contract is paid in full. The other bucket that I put it in, seller financing in, would be just a traditional noted mortgage. So you might not think of that as being seller financing, but you can act like the bank, and I view that as seller financing as well. So the difference being that in that case, of course, just like a traditional transaction, you would actually pass the deed and sell the property immediately, but you're still seller financing it because you're retaining the mortgage. So those are the, on the very basic level, those are the kind of the 2 ways you get about the seller finance to seller financing.
Okay, thanks. Thanks for that explanation. Justin, I'm going to go to you and just kind of ask you, what are some of the different types of seller financing that you've worked on or done in your experience?
Yeah, I think with that you can add different parts and pieces to it. On the seller financing end, land contracts are usually the most commonly used. I think people get into that quite easily. People understand it in Michigan anyway. The creating a note on the back end is usually something that people aren't as in favor of because they don't want to give up the deed right away and fight getting that back, doing the foreclosure process. It's a little different on that end. People also can get into more of like a rent-to-own type of a program where a portion of their rent payment would go towards the purchase price of a house. I'm trying to think of anything else, but those would kind of be the main categories, I guess you'd plug them into.
And Javier, let's go to you. What are some of the reasons both that a seller might sell using seller financing or a buyer might need to buy using seller financing?
Well, some of the reasons that the the buyers needs to buy as a seller financing is that they know they don't have a credit right now to go to the bank and get the financing, or they don't have the documentation sometimes. So that's one of the reasons that the people look for seller financing.
So the buyer it may not be able to qualify for a traditional loan.
Correct.
At a bank or with a regular institution.
Yeah.
But yet they have the money to pay.
Yeah, one of the things that we normally do is I'm a real estate broker in Wyoming, and a lot of people knows me, and they come to me and they're looking for a property that they can buy it in as a seller finance, and they already have saved a lot of money. We normally, because the market the way it is right now, it's very strong market. So we really require they put up very big down payment. Right now we are requiring $15,000 to put down, but now we are changing maybe around $20,000 down. So we got tons of leads with a lot of money that they can put down to buy a house.
So explain
And,
how that works. So you have buyers who have $15,000 to $20,000 to
Correct.
put down on a house, but yet they can't qualify for a loan. Part of what you do is connect those buyers with investors, right?
Correct.
Can you tell us about that?
Yeah. So they come to us, and then we require that they bring the proof of that they're working. So they got a good job history with a good amount of money that they can make. Normally, we require that between husband and wife, they make $4,000 or more, and then they're $15,000 or $20,000 to put down. Then once we get them all the documentation. Obviously, we check the credit and the background to those people, and then we reach for our investors who comes and buy the house for them, and then they sell it in a land contract.
So the investor buys the house, sells it back to your
Correct.
end buyer
Correct.
on a land
Yeah.
contract.
And we disclose everything. We tell them, hey, you don't have any options. This is the only option that we have for you. So they're going to buy it for you, and they're going to resell it to you with a different price. So they know already that it's going to be a markup in the land contract. And we try to that the markup not to be more than the market value, because what we do is, because they come with the cash, we're trying to get the house a little bit 10% less than the market value, and try to sell it for market value or a little bit more, but not too much.
Okay, great. And Steve, you've been both a buyer and seller using land contracts. Can you talk about your experience on both? Well, let's start with your experience as a buyer of land contracts.
My wife and I really like to buy on land contract or seller financing when we can. And the main reason we like to do that is because it allows us to do more deals, because, the banks only allow you to borrow so much money. And we have found that if we can buy it on a seller financing, we can usually work with the seller easier than working with a bank. You can close faster. And oftentimes, someone who's looking to sell their property, they want to close fast. Probably the way we do it different than a lot of people is we're still not afraid to put 20% down to buy a property. Oftentimes, when you think of seller financing, you think of people who they only want to put 5% down, or they want to get into a property with no money down or something like that. One of the things that we hope makes us more attractive to a seller to sell to us on seller financing is the fact that we're willing to put 20 or 25% down. And part of that's just because my wife and I are a little bit debt adverse in the fact that we never want to be over leveraged. So oftentimes the seller financing will look at us and say, hey, they're a good credit risk. We are not afraid to also share our credit score with them, because we have almost an 800 credit score, and we'll just say, hey, here's my credit report, I ran it, so they feel very comfortable with us. And if you're looking to buy with seller financing, one of the things I would say is you got to get your seller financier comfortable with yourself. Take time to take them to breakfast or lunch, get to know who their kids are, get to know who they are. One of the deals we did with a seller financer is he was in his 80s, and he knew that when he died, and that his daughter was going to inherit the money, and he was afraid that if she inherited the money all up front, she'd blow it in a few days. So one of the reasons he wanted seller financing was the fact that we could guarantee her income for 15 years every month. And so for him, it was very important who we were. We just sent him a letter cold turkey. So we had to spend time getting to know him. And my first thing was, hey, can I just buy you breakfast? And I said, where's your favorite place for breakfast? And he went with the most expensive place in town, the Coney Island. And so I bought him breakfast, and it was funny. We sat there for 2 hours. It was a cold January day. We sat there and had breakfast, and his pickup truck was running right outside the window with his dog in it the whole time we were there. But, that's how I got to know him. And I think I took him lunch a couple other times after that. But I want to continue with this story because there's an important point here. I bought the property. It had, at the time, two units and a house on the same property. So I'm getting what I thought was 5 units. And we did a land contract. It went very well for a year. And then the lady who lived in the 2-unit, she died of cancer. And I went in there and we needed to do a total rehab. Well, I was going to go to a bank and get financing. They didn't like the fact that I was selling a seller financing or land contract because they said, hey, you don't even have deed to the property until you pay it off in 15 years. So they wouldn't loan me any money to do the rehab. So I went back to them and I said, hey, what I really need to do is convert this from a seller financing to a traditional mortgage and note, which you normally do with the bank. And his attorney's response was, why would you do that for him? And he responded, because I trust him and he's a good guy. And so he convinced his attorney. The attorney drew up the documents. We converted from a traditional land contract to a mortgage with a note. I was able to get financing from the bank, and we rehabbed the property, and now it's a gorgeous place with 4 college kids in it. But that's kind of one of those things. You got to get your sellers trust, and you got to earn their trust.
Yeah, you have a much greater relationship when you're dealing with a land contract with the lender than you would if you were just dealing with a bank. Yeah, Dave.
Well, I'd say it's just as important for you to trust your seller. So the seller has to understand and trust you, but particularly when you're putting 20% down or a large amount down on a land contract, one of the advantages from a seller standpoint is that if you don't carry through with your land contract, that's forfeited immediately, or it can be easily forfeited. So when you're buying on land contract like Steve's doing, you just need to be very comfortable with the person that you're buying from, because you don't want them to possibly have that in their head and try to call some sort of technical default under the land contract to grab that money. So I think it is very much a two-way street when an investor's buying on land contract in that respect.
Dave, for sellers who would consider selling on a land contract, how would you advise them to protect themselves and protect their interests?
Well, there's a few things that I look at from a seller standpoint. One of which is typically if I'm representing a buyer, I want to record a memorandum of land contract. Well, I take the opposite approach actually when I'm representing a seller. I don't want to record the memorandum of land contract, which some people view that as kind of a standard item, but I'm not sure if this is necessarily a protection for sellers, but it's just a recommendation for sellers that if you can avoid recording the memorandum, if you record the memorandum, you're required to go through the forfeiture process. If you don't, because it's of record, so you actually have to go through and get a court order to clear that from the real estate records. If you don't record the memorandum, it makes it easier if the buyer ultimately doesn't carry through with the land contract, because they can just give you the keys. They could give you a deed, but if they vacated and you can't find them, you would still have to go through the forfeiture process and go to court. Versus if you don't record the memorandum, or if you don't record the memorandum, you could avoid that process potentially. Otherwise, I'm not sure there's great. Otherwise, having a great land contract is important. I'm not sure what other significant things you can do from a seller side to protect yourself, except for getting a larger a larger payment up front, down payment, and doing the normal things that you would do from a credit standpoint to make sure that the person can actually pay. Those would be the more typical things, maybe not necessarily legal, that you look at anyways.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
So that's from a seller standpoint. Now, from a buyer standpoint, how would you then differently advise the buyer?
Sure. I like the large. I would not put I think certainly you get. It's attractive to the sellers to put a lot of money down. I would be, and maybe you can get different terms or better properties if you do that. But obviously, from a buyer standpoint, you want to limit the amount of money that you're putting down, in my perspective, on a land contract, if you can. I guess you determine that on a case-by-case basis. And then, of course, you would just do the opposite of what I just said in terms of you make sure you record that memorandum, because that protects you. The other thing you have to look out for on the buyer side is if there is already a mortgage on the property, you're kind of putting yourself at risk because you're buying this property subject to a mortgage. And unless you get something from that lender that's ahead of you, they could foreclose their mortgage and you've just lost your down payment in the house. So that's something you have to be very careful with. And that issue does come up with some frequency, where a buyer might try to negotiate either direct payment to the mortgage company or trying to identify some verification that the payment that the buyer's making on the land contract is actually going to the mortgage company, and that if the seller's not paying their mortgage, you're paying them, but they're not paying the mortgage. That's a pretty significant issue. So if I was on the buyer side, those are kind of the main points that I would focus on looking at. So the question is, if you record the memorandum of land contract, how does that affect the mortgage position and so forth? If you record if there's already a mortgage of record in the real estate, on the real estate when you buy it, and you record a memorandum thereafter, you're subject to the mortgage. So all they have to do is foreclose the mortgage, and then your land contract interest would be discharged. You would have to move out. You wouldn't have your property more. However, the memorandum does protect you if there's not a mortgage on the property when you buy it. In theory, the seller could still put a mortgage on afterwards. So the memorandum in that circumstance would protect you. So if you buy the property and then they try to get cash out of the property after you buy it, which, again, you could prohibit that in your land contract. If you're the buyer, you could say you can't do that. But some land contracts, if I'm representing a seller, I'm going to specifically allow that, actually. I'm going to specifically allow them to put a mortgage on it and just provide that right for the seller. So that's the importance of at least you can draw a line in the sand. You should get title work when you're a buyer at the day that you buy the property, and make sure that, and possibly even you can get a title policy at that time, ensuring that there's not a mortgage on the property. And then the title company would require you to do that. They would require that you record a memorandum of land contract at the time of closing, just for that purpose, because that protects your interest, so they can insure your interest if you do that.
Yeah, I think this highlights the fact that a lot of people like seller financing because it's quick and easy. You shouldn't look at it that way. You should always get a seller, get title work done, have all the things done. I did a survey, we did title work, had the attorney on both sides, so he had an attorney representing him, I had an attorney representing me. You want to make sure you do it right, because, the other thing I didn't like about the land contract, knowing that I was going to make payments to his daughter for 15 years, was the fact that, I don't know the daughter. I knew the seller, I didn't know the daughter. And so after a year, I got a little uncomfortable with the fact that, and that really incented me to go back and convince him to do a note in the mortgage, because now I got the deed up front and I don't have to worry about wrestling the deed away from the daughter in 15 years. So that's another reason I converted because I just felt a little uncomfortable with that.
I just wanted to be clear, when you converted that to a mortgage, it was structured like a traditional mortgage, but the seller was the bank.
Yeah, that's exactly right. We always record, because we borrow quite a bit of money from private lenders to buy properties, and we record the note, we record the mortgage at the Register of Deeds every time, because we want to protect their interest. We look at it as a two-way street. We really try to be fair with everybody we do business with, and so we want that mortgage recorded. Because if I get hit by a truck, my kids have got to know they got to pay off that mortgage. And, if he gets hit by a truck, his kids got to realize that he's the holder of the mortgage. But we let him just function as the bank. And, we always, little things that we do to make this work is if the mortgage payment is due on the 15th, we'll set it up so it comes out of our account on the 10th to make sure that it's not delayed in the mail, there's no issue, so that on the 15th, he gets his check. We're pretty anal about that because we just want to make sure that we're servicing him because we want to borrow a second or a third time from our investors.
Justin, why don't you keep nodding your head? I feel like you want to chime in. So
Oh, yeah. No, I got a few things. I think it's a good thing. We've picked up a group of homes, and it's the same thing. We built a relationship with a guy. I was actually outside one day, and we were loading a roof with shingles, and the guy was looking for a roofer for one of his rentals. But we built that relationship and that trust, and a couple years later, he approached me wanting to sell. I think he sold 5 properties to us, all on a land contract. But with him, it was one of those things. He knew I was in the area. He knew what I was doing. We'd met up a few times. We'd helped each other out. We'd given him subs, to fix some of his problems. So it's that pre-built relationship that really helps the process out. And then also, as David was talking about earlier, we actually picked up a foreclosure that had a land contract on it, and it was in second position. So we were quitclaim the rights to the property of the bank, essentially, and had to go through the foreclosure process on somebody that had been out of the house for years because that land contract was still on the deed. So it is very important when you're going through the process. That's why if you can, always go to a closing company when you buy properties. Go to a title company, have them run the title search. We knew ahead of time that it had the old land contract on it, but it's still painful when you talk to these people and it's like, hey, we haven't lived there in years. The only reason we stopped paying was because the house was getting foreclosed on. So it was kind of a sad situation that we had to foreclose on somebody that was making payments back then at the time. So be cautious of some of those issues as well and make sure stuff gets recorded.
Javier, as you work with your clients who are buying on land contracts, what kind of advice do you take them through?
For the buyers?
For the buyers.
Well, one of the things is what I tell them is not to buy houses that they have mortgage on it. If they is free and clear the house, it's better for them because you never know what is going to happen in the future. So that's one of the advices that we do. And normally the investors that we work with, they have their cash. So they buy the houses in cash.
Yeah, the investors who buy with cash, they would not have a mortgage.
Correct.
Do you then advise, like Dave would for his buyers, advise them not to let the seller investor put a mortgage on it after he's created the land contract? Is that something that enters the conversation?
You asking me or just me?
I'm just asking you because
Okay.
I'm wondering, has that ever been a problem where a buyer has bought a land contract or bought on land contract and then the seller has put a mortgage on it? Has that ever led to issues in any of your
No.
experiences?
What they do is they normally sell the land contract to another entity to collect the payments. So they sell it in the note. They sell the note.
So they create the note
Yeah.
by selling on land contract and then they flip the note.
Yeah.
Is that typically what happens?
Yes.
Yeah, I'm new to this and really just want some basic nuts and bolts how-to. My attorney has told me that Dodd-Frank makes rent-to-own illegal, and it must not be. What forms should I use? Where would I get them? And if I just want to start, any basics that you can give me?
Great. Gee, it would be great if we had someone on this panel
I
who
don't
could
accept
answer
that question.
Yeah.
Please sit down.
Here, let me start, and then I'll turn it over to you, if that's all right.
looking your way.
So I used to do more rent-to-own stuff, and when Dodd-Frank happened, my attorney's advice was to stop doing rent-to-own. But I still like the philosophy. So what we did is we switched over to a lease with an option to buy, and the whole purpose of that is we did not. My attorney's advice was basically don't give them any equity stake in the property because it changes the dynamic. So if you can do a lease, a regular rental agreement, and they have an option to buy the property, it's different. And then with your option to buy the property, you could reduce the purchase price so much a month if you wanted to, but just don't give them any equity stake in it because it does get, Dodd-Frank's very, I think, gray in this point in time. And David will be able to answer to that quite a bit more, but it really scared a lot of people, and I guess it still scares me a little bit of I don't want to be in violation, and I'm not a mortgage broker, so I don't want to go through the whole origination process with them. So I kind of stepped back from that and went to more of a lease with an option to buy versus a rent to own.
I guess the only tweak I'd have on that, and then I can expound a little bit further, but I think giving them a reduction in purchase price with the option could be, you might be crossing the line a little bit. So you can give them an option on the property, so lease with an option, but once you start crediting amounts to the purchase price that ultimately is going to be paid, it starts looking more like a land contract. So I think it's still in the middle somewhere, but I think probably if you want to take the most conservative approach, you just wouldn't have that, maybe you adjust the purchase price up front to be a little bit less. And then, but you're not actually providing for a credit because that looks like a land contract. On a broader, look at this from a broader standpoint, and I just, in preparation for today, I did an update to see, because there hasn't been any cases that I'm aware of that have, that's been brought against someone who's selling on land contract, maybe in violation of Dodd-Frank or one of the related rules. And I still don't think there has been. So there's no published opinions or cases that I'm aware of on this issue that someone has come and said, hey, you violated these rules of Dodd-Frank. And by the way, there's some question of what rights somebody would have anyways, whether they actually would have a cause of action or whether that's just a governmental enforcement action that would be brought. But ultimately, and I'll get into whatever details we want to get into, but there's kind of two thresholds. There's a 1 property threshold and a 3 property threshold. If you're an individual selling on land contract, meaning not an LLC, so if you're an individual selling on land contract, you can sell 1 property per year without violating and becoming subject to the Dodd-Frank requirements. And I guess just on the simplest level, that means the question here is whether you need to involve a mortgage originator or not in the process, or a mortgage broker, a licensed mortgage broker in the process. You know, the end around of all of this is just to involve a mortgage broker who's licensed. Of course, you have to pay them a fee, so that starts cutting into what you're trying to accomplish. But if you're selling more than 3 land contracts, you probably have an issue. So that's kind of the general rule to think about. If you're selling 1, so long as you're selling it individually, meaning not out of an LLC, you're okay. But there are some specific rules related to that as well. And sadly, I wrote some of them down just to make sure I didn't meet anything, and I'll just run through them very quickly. So, and then take notes or see me afterwards. But 1 property, every 12 months, you can't be the builder. You can't build the property. You can't have negative amortization, meaning it has to, the interest whatever payment they're making has to be sufficient to cover the interest you're charging. They can't get behind every month. You can have a balloon payment, but it has to be a fixed rate interest, and there's no need to verify their ability to pay. Now so that's the 1 property rule, and then very briefly on the 3 property rule, it can be an LLC, all right, so you can sell it from an LLC, but in order to sell it from an LLC, you're subject to a couple different requirements than what I just mentioned. First, no balloon payment, so it has to fully amortize. And secondly, you have to verify that they have an ability to pay. And there's some very specific federal rules about verifying their ability to pay. So once you get past that 1 property, you start getting into these more complex rules, and I don't want to bore you any more than that, but that's kind of that's the very broad stroke on the requirements. And a couple other points, I suppose, is only applies to, it does, so if you're an investor, if you're selling to an investor, it doesn't apply. So just think about this as applying to someone, an individual that you're selling to from a consumer purpose, 1 to 4 unit type of thing. It doesn't apply to vacant land, doesn't apply to commercial properties. So if you're selling on land contract in that respect, you're okay.
Would it apply to someone like Steve here, an investor who's buying a rental property?
No, from what I understand, if you're buying it to rent it, or you're the investor, so you're okay. So Steve's situation, you could sell to as many Steves as you want to.
So Dodd-Frank is really meant to protect home buyers
Correct.
at the end of the day.
And the other thing, I hate to even recommend, I'm not recommending this, but if you sell to an LLC, technically, you would not be subject to it. So you have to sell to an individual. So it's possible. I mean, there's these little loopholes. None of them have been vetted, right? But if you sell to an individual, you're subject to these Dodd-Frank requirements. But if you ask your buyer to set up an LLC and you sell to the LLC, even if it's a consumer who's going to live there, now that has other repercussions for them from a property tax standpoint and everything else. But technically, if you're selling to an LLC, you're not subject to Dodd-Frank. But I like looking at substance. I mean, if you ultimately got under the microscope and if you were doing hundreds of these transactions, I don't think the feds would like that very much, but there are a number of little loopholes like that none of, like I said, have not been vetted. So you're taking risk if you're going to try to use one of those, but there are some ways to get around it, I suppose.
So my question was, you mentioned a little bit earlier about the risk of putting down a down payment. How are the forfeiture rules, or are the forfeiture rules different? You just mentioned they're different federal rules at the federal level for if you're doing a land contract for a homeowner versus an investor like Steve. So the question is, are the forfeiture rules any different?
The forfeiture rules are identical. There's two ways, and I don't know what perspective you're looking at this from a seller perspective or buyer perspective.
Well, so I would be looking at it from a buyer perspective.
Sure. So from a buyer perspective, the seller's going to have two remedies. They can forfeit the land contract, which essentially means we're terminating the land contract. All right. So that's why you lose your that's why you lose the money you put down. So forfeiture, you'll lose the deposit, and it's more or less an eviction proceeding. They have to give you a 15-day notice. You go into court, and then you have, in most circumstances, 3 months to redeem. So you do have some protection from a buyer, even in that process, is that you have this redemption period, but you have to come up with the money at that time, obviously. So you do have some protection, and then there's a longer, the benefits of the buyer, I suppose. You lose your money, you lose the property, but you actually don't have to pay the rest of the contract. So on the buyer side, if they go through the forfeiture process, your liability is limited to, really, you don't have any liability during the forfeiture process. You just lose your deposit. They can't sue you. They can't obtain a money judgment against you. So that's kind of a benefit, I guess. But typically, every land contract is going to allow them to also follow this longer process. It takes about 12 months. That's a foreclosure process where they can get a money judgment. So the seller has an ability to get a judgment against you if you don't pay the balance, just like a note in a mortgage. But in 95 or more % of the cases, they just go through a forfeiture process, get the property back. So what you have at risk is that deposit. And you do have a right to redeem. So you are protected. And it doesn't matter whether you're, back to your initial question, it doesn't matter whether you're an investor or whether you're a consumer or whatever. You're protected by those same rules. And you're also protected by your land contract. So if you're on the buyer side, they're required by law to give you 15 days. I mean, you could negotiate that to be 90 days. I don't know. So if you could negotiate that notice period further as well.
But a number of properties on land contract, commercial and residential ones, and we would close, and then after they were paid off, we'd close again, and so forth. But listening to some of this stuff, help me understand what's the downside of a seller financing with the traditional mortgage setup? Is it just the cost of it, or is the risk, or what would be the downside of that? Just to have it clean where the buyer was entitled and then they were paying the seller through a traditional mortgage type setup. What's the steps for that, and why isn't that the standard?
I think it's more of just a forfeiture process of when you're doing a land contract, it's easier to get the property back if you're the seller. Where if you do the mortgage side, you've got to go through the foreclosure process, so it just takes a little bit longer. In
Yeah,
total.
I would agree. It's the mortgage and the note versus if I'm the buyer, I want the note in the mortgage. That protects the buyer. If you're the seller, you want the land contract generally. Because you're more protected because you're in title. You're vested in title. You don't have the issue where somebody's going to the seller's going to put a mortgage on the property. You've got a longer redemption period. It's harder to get the property back with a note and mortgage. If you're the buyer, it's harder for the seller to get the property back. You have less at stake.
Okay, I guess I want to know a little bit more for the two of you guys that have bought investment properties on land contracts, what kind of terms you negotiated and why you think you got into a land contract based on those terms. Does that make sense?
Yeah.
Sure.
Okay. Normally, when I work with investors, they want the return of their money. In particular, I have one investor who they put the money for a 10 years amortization. So they get the money in 10 years, and I make sure that the buyers can put they have enough money to pay the payment and interest every month, and that's what we normally.
What kind of terms would they expect? Like what kind of interest rate? So a 10-year amortization.
10 years amortization,
what kind of
10% interest rate.
10%.
Yep, 10% interest rate. And if you make the math, it's going to be probably 8-9% return on your money yearly. Yeah, something like that.
And since some of your investors then flip the note, what kind of profit are they making off of flipping the note?
I don't know about that. I don't know how much they sell in the property.
Yeah,
Or
I
the
guess
note.
to answer your question is, when I buy, for example, we bought a 3-unit a few years ago,
Yeah.
and I owned the single family next to it, and I knew it was owned by an elderly couple, so I called them and I said, hey, are you interested in selling? No, we're not. And I said, well, if you ever change your mind, let me know. 3 years later, I call them about once every 6 months, put them on my calendar, call them once every 6 months, say, hey, how's it going, Bob? Things are, Well, he finally called me up in January and said, yeah, we're ready to sell this year. Can you sell? And I was, boy, I've got a lot of deals going and I got a lot of debt. I really can't afford to just cut you a check or to go out and get a bank loan right now. And he goes, well, we'll sell it to you on a land contract. And so we put 10% down, and we were talking with the husband and wife over dinner, and I'd gone with my proposal. And someone told me when you're negotiating, let the other person go first. And so I had in my head that I was going to offer 6% interest. And so I made my proposal on the dollar amount, and we were talking, and they said, I can't remember how it went, but they said something, but we could do better than that on the interest rate. And I'm thinking they want 8 or 10. And I said, well, what do you mean 8 or, well, how much better can you do? Oh, we'll sell it to you for 4% interest. And so I tried not to smile, and I said, we'll take it. And the only thing they said to us was, they said, we'd like to go to dinner once in a while with you guys after you bought it. So now, twice a year, we call them up and we go to dinner with them. Nice couple. They own some chestnut trees. You ever remember the Christmas song, Chestnuts Roasting Over an Open Fire? Well, he sells them, has an orchard. So we took 2 of our grandsons, went up, did the whole chestnut roasting over an open fire with them, and, we just have a good relationship with them. And my attorney at the time when I'm talking to him, he said, instead of, because they wanted a balloon in 3 years, he said, why don't you ask him for 6? And so I asked him for 6, and they said, sure, we'll wait 6. And so at 4% for 6 years, I don't really want to refinance it. I'm going to go the full 6 years. And, now, it's some property that we've had to put some money into since we bought it. But, it ended up being a real good deal for both parties. They even said to us at several times, hey, if you guys ever get tight and you need a few extra days on the mortgage payment, just let us know. Now, we've never taken them up on that. We make the payment every month. But I think they're the kind of couple that if we went and asked for more money, they'd probably loan it to us because we've been paying for 3 years and never missed a payment.
So, just out of curiosity, though, when you go out to dinner, who pays?
Well, sometimes we buy and sometimes they buy, and it's an interesting question. For Christmas, they sent us a Christmas card with a $50 gift certificate in it. I mean, a gift card in it. So they're just great people to work with.
Yeah. No, I had a similar situation. I talked about the guy when we were loading a roof. A couple years later, he's just like, I want to sell, I want to give these, I want you to have them type of a thing. So it's really I really don't know, I really don't want them. He had them listed for a while. That was an unreal price. And he's like, yeah, but I've been thinking about it and I just want the monthly income. Like I've lived on this rent for 10 years and I'm retired and I like having my Social Security check and I like having this rent, and that's kind of what I live on. So same thing, we negotiated out, I think I gave him 10% down. And he just wanted the federal minimum interest rate. So, I pay nothing in interest on this thing. And it's on a 15-year note, and, things are great. It's fully ammed on 15 years. It's a super cheap payment for 5 properties. So it was a great deal. It was that connection that you'd made with him prior, and he was to the point of, okay, I listed it, it didn't sell. I know you, I know what you're doing. I see what you do. I like what you do, and we connected, down the road. It was never the upfront thing. So anything is possible when it comes to the seller financing end, and the more you can know your seller, the more it'll help you out. And same thing, we get together every time he goes to Florida for like 8 months a year and comes back for 2 and goes up north somewhere. So we get together every once in a while and just make sure everything's okay, and just very generous guy. So
Another question.
Yeah, Javier mentioned a 10-year amortization with a 10% APR, and I think you said you're getting 10 or 15% down, or 15 to 20,000 down. Is that rent to own or land contract? And then I want to go back to the legal advice. Is that in one of the gray areas with Dodd-Frank again? Or would that be relatively solid legal situation for me as a seller?
You mean getting $15,000 down, that type of thing?
Yeah, having a 10-year, the seller more or less being the bank, and you're going to take the 10% interest.
Sure. Yeah, so you can charge whatever, you can charge the interest, 11%. You should stay under 11% interest. But otherwise, you're free to charge. The interest rate is not an issue with Dodd-Frank if you're staying under that 11%. And the amount of down payment or amount you seek up front is not an issue. But you just have to be cognizant of and watching the amortization of that then, right? Because it needs to if you're, go back to those rules, if you're obligated to fully amortize, it's just going to increase the payment if you have a higher interest rate, so you need to make it work with what the person can afford to pay. Otherwise, you're free to do what you want to do.
And then in that situation, they own the property at the end, or they have that's not an option to purchase. They would own at the end. So that's not a
correct. If they paid off the
lease
land
option to purchase.
Correct. If they paid off the land, which I think is what I'll let you answer the rest of it. They would own the property once they pay everything, or they refinance it with a bank. Then they would get the deed at that point. Correct. Yeah.
And go ahead.
Yeah. The amortization is 10 years, and normally we require 20% down. So if it's $20,000, they can only buy a $100,000 house. They cannot buy more than that. If it's $15,000, it's like, you do the math, maybe $80,000 or $75,000 house. But we cannot find houses for that amount right now. So we have to increase the down payment to $20,000 so we can get them houses for $100,000. And that's what we require, 20% down. And then the amortization is 10 years. Payments is going to be around $1,057, and then they fully pay the house in 10 years.
I'm gonna go out on a limb here, and I think I can go out on a limb easier than David because I'm not an attorney and I'm not offering legal advice.
I'm not offering legal advice either.
But one of the things that Dodd-Frank is really concerned with is fairness to whoever you're dealing with. And so I think one of the reasons we haven't seen a lot of, I'm hoping one of the reasons we haven't seen a lot of litigation on it is because if you treat people fairly, they're less likely to come after you anyway. And here's my example on that. Number one, you stay under the usury laws of the 11%, which he mentioned. But the other thing that's important, I think, is when I look at if I'm going to sell a house or if I'm going to lease a house to somebody, I now got to comply with all the city requirements, which, has own set of rules with it. And the other thing is, one of the big issues is when you look at the total expense for both parties, in Michigan, you have this homestead property thing. So if I go buy a house, my taxes are higher when I go to lease to somebody, so I got to raise the rent to cover my taxes. If I sell to them on a land contract, they get the homestead property exemption, so their taxes are lower. So when you look at the total fees and the total expenses to the whole transaction, as long as I'm being fair to them, and in this case, I'm saving them money because why just pay more to the government because they got to pay more rent to me to pay that. The whole economics usually work better. Now, I don't do a lot of land contracts. I've done 3 in my career where I've sold on land contracts, and those were because I had bought the properties in my IRA, and what I didn't like was I'm more concerned about my IRA complying with the rules there of not self-managing it. So I didn't want to self-manage these properties, and so I had to hire a, property management company, and 2 of these houses were way up north, and it was very difficult. So I knew people wanted to buy them, so why don't I just sell it to you on a land contract? So we drew up a fair land contract and sold it to them on a land contract, which for me was a lot easier. I don't have to worry about the repairs in the place. They do all the repairs. I don't have to worry about anything, and all 3 of them are paid off now, and they own the house, and so these were actually before Dodd-Frank to begin with, but the fairness is a big issue.
Yeah, and I think that's part of Dodd-Frank's creation too, is a lot of people back then were doing short-term balloons. So they'd put $20,000 down and have a ridiculously high interest rate and then have a 2-year balloon with people that could never pay it off anyway. So there were people out there that were really taking advantage of people that didn't know enough about the process. So I think that's what Dodd-Frank kind of helped some people out where they were getting into these land contracts. There was no way they were ever going to buy this house, and people were just taking advantage of them because they were getting a big down payment and a super high interest rate, and they could never get a mortgage when the balloon date came up. So I think that's part of the process there too.
Okay, so we're in overtime now. We'll take one more question.
To get back to land trust, I think you misunderstood what I was trying to say. What they was talking about in the seminar was to go 0 down, 0 interest rate on a land contract and put the payment name into the owner's, the seller's name so that the payments are made in their name in the trust, but it didn't put them in a trust, but just put their name on the trust, something like that. And to get around the due on sale clause, basically.
So you're simply trying to avoid the due on sale issue. I suppose that works. I'm not overly concerned about. You mean sellers trying to avoid the due on sale provision, and you're just trying to make it look like it didn't happen, more or less. I think I usually advise people that. Whenever these happen, that you do have due on sale issues, right, and all kinds of transactions that people usually ignore, and oftentimes that doesn't come up. I'm usually not overly concerned about the due on sale provision on a smaller property. We understand it's a risk that's outstanding, and we just move forward on that basis. But what you're saying, you're concerned about the due on sale being triggered because there's some underlying financing on the property, probably. That you could be subject to. So
and due on sale is the lender who might hold the mortgage.
Right, so the lender could call the loan.
Would call the loan because
so the lender could call the loan. I think it helps, right? Okay, so that structure could help, but I don't know if it's necessary. It helps, but I think if the lender identified that you had a transaction, that a transaction did happen on the property, I can almost for sure guarantee for you that you've probably violated the due on sale clause. I mean, it's a substance issue. It's a substance issue.
And if you are buying a property with an existing mortgage on it, with a land contract on it, the lender can approve you to do so as well. So they can modify their mortgage where the due on sale clause is not, acted. So basically both of you would stay on that mortgage at that point forward. So you've got to go through and get approval from that lender, but there are other options.
The structure that you're proposing is less apparent to the lender by looking at the records that a sale has occurred. But if the lender cares about this issue and wants to call the loan for some reason, like I said, I do a lot of lending work, and I'm fairly certain there will be something in the loan document that will be sufficient for them to call the loan on that basis, even if it just becomes less apparent because of how the title is. So it's better, I suppose, on that from that basis, but I don't think it's not a guarantee. I guess what I want to leave it on.
Okay, great. So I want to thank everyone for coming this morning. I want to thank our panel. Let's give them a round of applause.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.